and I'm a junior in the AIM program covering domestic healthcare. The company I'm going to be pitching today is NextGen Healthcare, ticker NXGN. NextGen is an ambulatory healthcare solutions provider that engages in the development and marketing of electronic health records, practice management, revenue cycle management, and interoperability solutions. The company generates revenue in four main segments: support and maintenance, subscription revenue, revenue cycle management, and professional services. The company was founded by Sheldon Rezin in 1974 and is headquartered in Irvine, California. Moving on to my recommendation. NextGen Healthcare, previously Quality Systems Incorporated until 2018, was originally founded in 1974 as a dental software company. By providing healthcare technology for outpatient care interconnected by medical, behavioral, and dental providers, NextGen has positioned themselves as a holistic, integrated solution platform that covers an entire enterprise. Service providers come to NextGen to find ways to reduce costs without losing on efficiency. By having dozens of partnerships with companies like Dell, HP, IBM, and Microsoft solution providers, NextGen is constantly improving the software and service packages that they offer. Since 2015, revenue has grown 7.8%, with net income increasing 6%. Revenues are driven by a new subscription model and expected to increase 25% in the next 5 years. Within the four revenue streams of NextGen, the products and services can be broken down into four main categories: the core, automation and workflow, analytics, population health, and patient engagement, and finally, interoperability. Choosing to focus exclusively on the ambulatory marketplace in 2016, NextGen acquired 7 companies in the next 3 years, each specializing in a new ambulatory service unique to the comprehensive NextGen platform. The NextGen platform serves as the company's population health management tool, which enables health service providers to improve their ambulatory care. The United States PHM market in 2018 was estimated at $3.1 billion and is expected to increase by over 200% by 2022, whereas outpatient volumes in 2018 at $3.5 billion are expected to grow 15% by 2028. In response to the changing U.S. healthcare field, the company started slowly moving out of their legacy products to focus on building out its more attractive revenue lines, such as support and maintenance, subscription, and electric data interchange and data services. For all of these reasons, it is recommended that NextGen be added to the AIM Small Cap Equity Fund with the potential 23% upside. Now to my drivers. 2019 acquisitions. As part of their strategic plan to remain at the edge of healthcare innovations, NextGen has gotten into the practice of acquiring companies that will have natural synergies within their organization. In late 2019, they acquired 3 companies: Topaz Information Solutions in October, MedFusion in November, and Auto Health Acquisition in December. Each company was acquired not only for their client base, but also for the specialization they offer to the NextGen comprehensive solution packages. In 2020, NextGen management expects synergies to increase the revenue line by mid to high single digits, and their expenses to decrease as another result of said synergy. By combining medical, dental, and behavioral services, NextGen is able to provide holistic customer service at a lower cost to clients, making them an increasingly attractive solution provider. The table is set for growth. New management joined the company in 2015 and set the company on a new course of growth. The company has divested its hospital solutions and replaced revenues with the NextGen Mobile and NextGen Analytics market in 2018. Mostly for the population health management market, currently greater than $3.1 billion and growing 22% through 2022. My apologies. With the changing dynamics for increased patient market share, the company is now positioned to benefit from this positive trend in the next 5 years. Long-term margin expansion opportunities. Management expects margins to remain flat for the next year, but increase thereafter. Heavy investments will likely pressure net margins, but are likely to be leverages beginning in 2023. Management will continue to invest in legacy product lines, but at an increasingly lower rate as tech deficiencies have been remedied. Combined with reposition growth and strong operating leverage, EPS growth should accelerate into the middle half of the decade. Moving on to my valuation. In order to reach an intrinsic value for NextGen, a 5-year DCF model was constructed. Using an internal growth rate of 2% and a WACC of 5.2%, intrinsic value of $17.09 was reached. Additionally, a price over EBITDA multiple valuation was calculated. Using a blended average price over EBITDA multiple of 10.1, this resulted in an intrinsic value of $16.33. Finally, price over sales multiple of 2.2 resulted in an intrinsic value of $20.47. By weighing the three models 60-20-20, a price target of $17.09 was reached, resulting in a 23% potential upside. NextGen does not pay a dividend. Now addressing potential risk. Data security. As a large part of their services involve electronic medical records, NextGen would be extremely vulnerable to a data breach if someone were to get into their systems. To counteract this, NextGen places an extra emphasis on data security in their practices, but this risk still must be considered. Potential failed acquisition synergies. Although all the acquisitions for NextGen have been strategic and the four before 2019 have been successful, we must still recognize that any time a company embarks on a merger and acquisition, there is a failed synergy risk. In the interest of time, I will skip over talking about management, and with that, I will now open the floor up to questions.
All right. Thank you, Joe. Let me take you to your price chart.
Of course.
I'm going to ask an easy question here. Two major drops occurred over the last year. What was that?
Yeah, for those drops, I'd say that was mainly the three investments they had that went from October to December. They have had 7 acquisitions, but normally this rate of 3 1/4 is unheard of. And so I'm not worried about that drop.
Did you get a chance to hear on the transcripts or read the transcripts or listen to the analyst calls if they questioned that and how management responded to that?
So management's very confident in their abilities to pay off the debt they had to take on to pay for these mergers and acquisitions. Management's guidance for NextGen overall is something I'm very satisfied with ever since they started these changes in 2015. With their 2016 mergers, 2017, 2018 mergers, all their guidance has been correct.
Now you got me asking another question. You said they used debt in the acquisition?
Yes, sorry. They, for their acquisition in 2016, they took out a lot of credit that they immediately paid off partially with cash. The acquisitions after that were paid with cash. I'm sorry.
Okay.
That 2016
debt to equity is basically zero.
Yes, sir.
So in your peer boxes again, all of your peer averages are telling me that your peer averages are better than your company. Your PE is twice as high as your peers. Your ROE is less, and so is your ROA. So can you just clear that up a little for me and tell me why NextGen is the right company?
Of course. So, like I was saying before, the reason I believe in NextGen is because over the past 3 years, since 2015, they have taken a new approach to how they approach healthcare, switching solely on ambulatory care. And so, with that focus, I see themselves well positioned in the next 5 years to come back from that. So, I recognize exactly what you're saying, and that's kind of what brought me to NextGen.
And then a follow-up, in your first boxes, your midterm EPS growth rate is 102%.
Yes, sir.
Could you give a little color on that?
Yeah, gladly. Great question. So for my calculus, I did a 5-year. So that's 2018 to 2023. And so something that I really appreciated about NextGen is that it's not on the box, but in 2018, their EPS was 4 cents. And so the improvement they had in 2019 up to 38 cents is why you see that 102%. Because their EPS was extremely low, and they raised it up again because they have moved out of their growth and development plan, are now in their execution phase.
So what would you say is sort of the expected normal longer-term growth rate over the 3 to 5 year period?
Yeah, so I don't have exact numbers, but after 2019, the range is between 38 cents per share up to 70 cents in 2024. So I just wanted to show in 2015 the transformation that NextGen had, which is why I used those years.
Sticking with your relative valuations, it
Sure.
looks like you're getting a lot of upside from this Cerner Corporation, which is like 25 times greater than your company. Can you defend your peer group a little bit?
Of course. So anytime that you deal with healthcare information systems companies, finding comps is a little bit hard, right? Because you're working in 2 different industries. So for my comps, instead of figuring it out myself, I went straight to the 10K and said what management felt was their biggest competition. So all my peer evaluations came from there.
All right, lots of hands up here. Gonna go with Bill.
If you look at the historical performance of your peer groups and compared your company to the, stock price performance or revenue performance or operating profit performance over the previous 5 years?
Yeah, I did not, just because with the unique ambulatory focus NextGen has, I didn't find any peer groups that specifically only dealt with ambulatory care.
But the knowledge comes from the same source, which is a hospital, correct?
Um,
Marketing to the same.
So ambulatory care is outpatient care. And so with outpatient care, you don't have to take care of that cost of hospital beds, paying people to monitor their rooms. And so the cost structure is a little bit different to me because other companies were not exclusively outpatient care.
All right, let's keep going. Sean?
I guess it's kind of a similar question. Can you talk about your competitors a little bit, or direct competitors, and maybe some market share for your company?
Yeah, sure. So as far as the comps go, CPIS is kind of the only one that's pure healthcare information systems to me. When I was looking at them, the other ones, although they deal with although they deal with information systems, to me they had a heavier focus on healthcare. And then as far as market share, I don't have those prepared right now.
Yeah, you mentioned data security being one of their risks. Have they had any issues with this in the past? And have any of their competitors had any issues with this? Like, how serious is this?
Yeah, so data security, especially in the healthcare field, is a huge issue. Especially in the past, from 2015 to 2018, we've seen hacking rates with health records go up, I believe, 68%. So as for NextGen, they do have very strong commitment to data security, and there's two important paths that they take. One, they operate with an incredible comprehensive security framework that is verified by an independent third party. Two, they partner with Amazon Web Services to secure their web services. Talking a little bit more about what they do, NextGen Healthcare uses the Health Information Trust Alliance framework, the most widely adopted security framework in the U.S. healthcare industry. Security framework ensures that they not only meet HIPAA regulations, but the standards of globally recognized security organizations, such as the International Organization for Standardization, the National Institute of Standards and Technology, the payment card industry, and others. HIPAA takes the best from these standards and incorporates some into their own set of controls. The NextGen Healthcare team reported they had to put day in, day out work for over 19 months to obtain the certification. So they take data security very seriously, and compared to their peers, I felt like they were pioneers in data security for healthcare records.
Right here, Nick.
So you have operating margins going up pretty nicely through 2022. In the most recent quarters, they were actually about 2.4%. And they've kind of been trending down recently. Where do you see that increase coming from?
Yeah, so we talked about Q3 that came out in January.
Q4. Yeah.
Oh, okay, yeah, gotcha, my mistake. So with operating income, the reason I see that going up is more of management's guidance. And so part of their plan is a multi-year plan since 2016 up to 2024. And so in their guidance for that, while their net margin is decreasing or remaining stable, they are increasing revenue internally to increase their operating margin.
Brooke?
Yeah, so you mentioned how like management is effective and going forward, but I was looking on the asset turnover ratio and the return on assets, and it's like substantially lower, proving that management has failed in being productive. Do you see that number going up in the future, and how sure are you in the management decision?
Yeah, so I actually love the management team. I know I didn't go over it for the sake of time, but I researched the 7 C-suite executives on their team, and all of them have very strong historical backgrounds from healthcare companies. To shout them out, Omnicell, Allscripts, Alliance Healthcare Services, as well as Eagle Dream Health. And with the management team, something I was looking at is on December 26, 2019, a lot of C-suite executives, I want to say 4 out of 7, exercise performance stock units. And so to me, that was confirmation from the management team that they're here for the long run, and they really do believe in the guidance that they're giving.
Hey, Joe, 10 seconds or 15 if you want to wrap it up.
Yes, sir. NextGen Healthcare is a one-stop. NextGen Healthcare is a one-stop healthcare solution company that enables healthcare companies to better their practices anywhere from client interaction all the way back to electronic data management.
All right, thank you, Joe. All right, Joel's gonna, where you headed? You going somewhere? You going on a trip or something?
Trip's next week. Today, we have to go to the US to get paid for it.
Yeah, you do with coronavirus. Oh, everything you got. Closing down. All right, Luca, you all set?
All set.
All right.
Hello everyone, thanks for being here. My name is Luca Cardamone. I'm a junior in the AIM program and I'm covering domestic consumer discretionary. Before going on with my presentation, I would like to mention that I'm pitching this stock as a consumer discretionary and not as a technology that was in the email that was sent out. Also would like to correct the short interest that unfortunately went up from 49.95% to 60. So it's 21. And I would like now, I have good solution to this problem. So I would like now to talk about iRobot, ticker IRBT. iRobot Corporation is a consumer robot company that is recognized for popularizing the Roomba's vacuum. Additionally to this product, they also sell mops and mowers. In addition, the company also offers two robots. One is called Create and one is called Root that teach kids how to program and code. The company sells this product through the following channel: online website. Amazon accounts for 14% of their online sales. Retailers, chain stores, and resellers. IRBT operates in the following geographic segments: Americas, which account for almost 50% of the revenue; APAC, 19% of the revenues; and EMEA, which accounts for 32% of the revenue. The company was founded in 1990 by 3 MIT engineers and is headquartered in Bedford, Massachusetts. I would like now to move on to my recommendation. With a rising interest in the Internet of Things, artificial intelligence, and smart houses, people are becoming more inclined to buy devices that connect and interact with each other. Furthermore, with the changing lifestyle that leave people less time to work on house chores, having a device that does cleaning and mopping for you is a much encourages the robot vacuum market to grow at a faster pace than the previous year. The robot vacuum cleaner market is forecasted to grow at a CAGR of 18% during 2020-2024. The iRobot is a pioneer in the industry and holds a 70% market share, excluding China, where it holds a 10% market share. iRobot is continuously bringing new technology to the market, and such as area of mapping and navigation, human-robot interaction, and physical solution. The company is working to build an ecosystem of robots that enables the smart home. iRobot is actually outsourcing from China to Malaysia to offset the huge tariffs, U.S. tariffs problem that's affecting the company. And by the end of 2020, iRobot plans to have 1/3 of their Roomba of the U.S. destined products manufactured in Malaysia. As I previously mentioned, the Root Robotics was the Root robot was added to the Roomba family thanks to an acquisition in 2016, and I believe that this is a strong thing for the company, as I see the coding is becoming a necessary skill and might soon become a required skill that people need to succeed at. Utilizing the Root robot to introduce coding to kids can be a fun experience that school can consider. iRobot has a very low debt and reinvests free cash flow in research and development. Since 2014, revenue is up nearly 100% and net income around 130%. The company guidance affirmed that 2020 will most likely be a transition year that will set the way for the future growth. For this reason, it is recommended that iRobot Corporation be added to the AIM Small Cap Equity Fund with a price target of 63.26, representing a potential upside of 34.92. I would like now to move on to my drivers. The company has a very strong intellectual property. As December 2019, the company held over 500 patents, 100 foreign patents, and more than 1,500 patents pending worldwide. This actually protects the company from competition and has allowed iRobot to shut down sales for many competitors such as Black & Decker, Bob Sweep, or other several China businesses. My second driver is bridge into STEM education. iRobot is determined to improve STEM education, which stands for science, technology, engineering, and math. The IC has a privilege that this is a skill that people will require, especially with having evolving workforce and the skills that are required in today's world. The company offers Root, which is a robot that teaches and introduces kids to coding, and Create, which is a robot that introduces kids to programming. The Root system can be introduced in classroom, and as of now, this robot is in more than 500 schools in North America. My third and last driver is growing trend for smart houses. The growing trend of the IoT and the future role of smart houses is a great opportunity for iRobot to capitalize on revenues. iRobot vacuums are Wi-Fi connected and can build this detailed map of the house, giving more knowledge to the whole smart house. Roombas can already work together with the Brava mops, and with the help of IFTTT, which is an internet service that lets people create simple connections between devices, iRobots will be able to, are actually able to take vocal orders with Alexa, Google Home, and Siri. And I also think that by connecting its products with other devices, the company can create switching barriers. For the second time, I would like to skip my evaluation and move on to my risks. Impact of a possible tariff increase. An increase of the tariffs due to the US and China trade war might affect the company, as they already did. And however, the company is doing a good job outsourcing in Malaysia. And as previously mentioned, in 2020, they plan to have 1/3 of the US testing the products produced in Malaysia. The competition. The robot industry is very competitive. Every year there are new entries in this industry, and the introduction of new products can erode some market share for the company. iRobot, however, is doing a good job of protecting his market share through litigation with, thanks to his strong intellectual property. Litigation expenses. As I said, they have to defend their market share through litigation, which probably can make extra expenses occur in the company. Management. iRobot benefits from a knowledgeable and talented management team. Colin Engel is the actual CEO and is a co-founder of the company and has been the CEO since then. There is a CFO transition. Julie Ziller will succeed Alison Dean, but this should not affect the company, as the new CFO has already 30 years in the industry and has already worked for 10 years with iRobot. I would like now open the floor.
All right, Luca, IP, intellectual property,
Yes.
patents, that's your most important driver and protection for the company. Convince me that they can protect their patents.
They actually have one lawsuit going on right now for Shark, against Shark, which is one of their main competitors, especially in the North American market. It's actually one of their competitors that is eroding a little bit of market share. Their patents are very strong because they are all connected to each other. So if one patent doesn't work for one lawsuit, it's actually connected to the next one. As it proved in the past, it shut down the sales for many other businesses.
Yeah, so Dr. Krause started this, but are any of these patents expected to expire soon? Like,
Yes,
still have these patents.
Yeah, the patents are expected to expire in 2022, and but they are as iRobot is introducing every day new technologies, they are filing new patents and applying for new patents.
That was a follow-up to Max. How do you know that? Did you actually go to the US patent website? and
It
look
was
at
on the
that?
10K. It was on the 10K.
Okay,
It was
good.
on the 10K.
Could you talk a little more about your second driver, the STEM education? Do you know how much revenues the Root segment is providing for you, and do you know the growth rate for that in the future?
Yeah, sure. The STEM education right now at the Root Robot is not a significant amount of revenue for the company, but it's supposed to grow at a very fast rate. The CAGR for this industry is 15.2 from from 2020 to 2025. And as of right now, in Massachusetts, for example, there are for every college grad, there are 16 jobs which are awaiting them for every graduate student that's studying STEM education. So,
What do you think the reason is for the high short interest and why are other people wrong?
yeah. So the short interest is definitely a big problem for this company. I think I actually got the chance to talk to investor relations yesterday, and the main reason that I was given are the U.S.-China trade war. They have 25% of tariffs, which have been increased in May 2019 from 10% to 25%. That's affecting the company. But as I said, they're doing a good job outsourcing in Malaysia. Also, the coronavirus right now is something that's affecting every single company. But iRobot has two of their plants are actually 600 miles away from there where the coronavirus outbroke. Also, the competition is a big factor in the short interest. As I said, they will most likely lose a little bit of their market share, but it's also true they have a very important market share. 70% in this industry is important market share. And also, they have some lawsuits also against them. They have been accused of inflating their revenues between the period of 2016 and 2019. But this I think this is not a major factor. In every single earning calls that I heard, there was not even one analyst that addressed this problem. And also, if that would be true, it would be already reflected in the prices. Since that period, it dropped almost 60% from 135 to 46. So
You were ready for that one.
we're not ready for that.
And you called investor relations. Everybody get that? You can do that, okay? And so good for you for doing that.
Yeah, so you mentioned the coronavirus and how that could be affecting manufacturing in China. Did they have any factories shut down?
Yeah, so
in China?
as you said, the coronavirus is affecting every company that has manufacturing in China. They actually have been prepared. There was actually an analyst that asked the same question, and the management replied that they are ready for Q1 because Q1 is usually a low production quarter for them, and as there is the New Year in China, and they are ready with producing ahead of time. Also, the two factories that actually are close to that where the coronavirus outbroke, 2 weeks after the news came out, they had 60%, 25% of the workforce already working in the plants. So it's doing a
Okay,
good
your
job.
last question was Shay.
It's more like a curiosity question. So which one of their products gives them the most revenue?
The biggest product is the Roomba i9 Plus, which is a disposable, automatic disposable.
How much does the Roomba cost, and then how much does it cost compared to competitors?
Yeah, the Roombas cost 999 actually. This is their high-end products. They offer many other products that also 200, 500. Where they see the most of their competitors, they're really taking off their market share is the low-end competitors, especially in China. And but when I think customers will start realizing that product will like a product you pay more works better, they will pay more.
Ellie, you get the last question.
So when you answered Dr. Kutz's question, you mentioned that Shark was probably your closest competitor. I understand they are private, but did you do any comparison between them and iRobot?
I did not because they I think actually the closest competitor is Ecovacs. This is a China based company, and which I included in my evaluation, and that's who I think is the main competitor.
All right, Luke, you want to summarize?
Yes, I think iRobot is right now is at a very good price to buy, especially thanks to the recent market conditions. The company is doing a great job. Management is constantly striving for improving and bringing to the company new technologies. They offer great products and they have very strong IP.
Very good. That's a consumer discretionary stock, not technology. Okay, we're going to stay in the United States with Andrew, right? Going to go. They're playing spring training baseball down in Arizona, right?
Got it.
We should do a road trip.
I mean, that's.
Yeah.
Good afternoon, everyone, and thank you all for coming. My name is Andrew Dietrich. I'm a junior in the AIM program covering domestic financials. I would like to talk today about how I found this company. For my screening process, I analyzed the holdings of small cap growth managers that I respect, looked for positions they have recently increased, and then looked at the company's fundamentals and relative valuation. In this process, I found Western Alliance Bank Corporation, ticker WAL. Western Alliance is a pure regional bank. 96% of revenues come from interest they make on loans to different parties. The loan portfolio of the company consists of 43% C&I, which is considered loans to businesses, 25% commercial real estate, non-owner occupied properties, non-owner occupied meaning investment properties where the owner does not live on the property, 11% commercial real estate owner occupied properties, 10% residential and consumer, and 9% construction and land. The company was founded in 1995 and is headquartered in Phoenix, Arizona. Now, onto my recommendation. Western Alliance recently reported the highest total revenue in the company's history, which drove their 10th consecutive year of rising earnings. The business segments of the company are divided into national business lines, Arizona, Nevada, California, and others. Regional markets mentioned have promising growth opportunities. California is the largest state by population. Nevada is second in terms of percent population growth. Arizona is third in terms of percent population growth. National business lines are managed centrally and are broader in geographic scope than the company's other segments, though still predominantly located within the company's core market areas. This distinctive business model allows Western Alliance to move capital throughout the year to take advantage of the best returns, highest credit quality, and least competitive markets. The minimum spread on Western Alliance's national business loans is 300 basis points, compared to the industry average commercial loan of 275 basis points, according to data collected by S&P. Over the past 5 years, national business loans as a percentage of total Western Alliance loans has grown at a CAGR of 33%. This success is due to the investment banking talent Western Alliance has attracted. Key employees have been landed by offering attractive stock opportunities to potential employees. This talent has been successful in growing the business with total loan growth of $3.4 billion in 2019, or 19% year over year, which outperformed the 7% industry average. All of Western Alliance's loan growth is organic. With current return on equity metrics, the best use of capital is to reinvest back into the business. Given this positive backdrop, potential for growth, and industry-leading return numbers, it is recommended that Western Alliance Bank Corporation be added to the AIM Equity Fund with a price target of $59.83, representing an upside of 22.9%. Moving on to Western Alliance's drivers. Loan and deposit growth. Looking into 2020, the company expects $600 to $800 million of loan and deposit growth each quarter. Management's guidance is consistent with 2019 performance, a period in which the company increased EPS by 17% year over year. They attempt to lead with deposit growth since it is a primary driver of EPS. As such, deposits are expected to grow in the next 2 years at 11.2% and 12.3% respectively. In addition to deposits, expected loan growth is 17.4% in 2020 and 12.5% in 2021. This balance sheet expansion will drive Western Alliance's EPS to a 7% growth over the medium term. Mortgage origination. Residential mortgages were a large driver of net interest growth in 2019, increasing to $2.1 billion. Management articulated that it intends to increase this asset class at a more aggressive pace to reach a target of about 25% of the loan portfolio compared to 10.2% current levels. This strategic shift is in line with the trend of mortgage origination and regional demographics. According to the Center for Microeconomic Data, in Q4 of 2019, mortgage originations rose by 224 billion to reach 752 billion, the highest volume seen since the fourth quarter of 2005. In addition, Arizona and Nevada are among the fastest growing states in the U.S. in terms of population growth. These macroeconomic data points provide support for the thesis of increased demand for mortgages in areas that Western Alliance can capitalize upon. Superior profitability. The company's net interest margin is 102 basis points greater than the peer average. The superior net interest margin is derived from the national business lines. Through this segment, they can find less competitive spaces to loan money where attractive spreads can be achieved. For example, in oversaturated markets in California, Western Alliance has no interest in battling 10 other banks for a commercial real estate loan with thin spreads and unfavorable terms. Given the strong financial position of the firm, Western Alliance is in a fortunate position of being able to pick and choose the places they want to search for yield. Overall, Western Alliance is positioned to capitalize on its expansionary balance sheet policies mentioned in the previous driver through an industry-leading ROA of 2%. In the interest of time, I'm going to skip my valuation and talk about the risks. Slowing loan growth. The major risk here to slowing loan growth is the deterioration of residential mortgage demand in the primary regional markets. A dilutive acquisition. If Western Alliance were to make an unexpected acquisition, it could backfire on the company as the market has not been kind to non-accretive bank mergers in the recent past. Finally, I'd like to talk briefly about management. The CFO of the firm, Mr. Dale Gibbons, has spent 16 years at the company and has 30 plus years of experience in commercial banking. Mr. Gibbons was ranked as the #1 best CFO among mid-cap and small-cap banks by Institutional Investor magazine in 2017 and 2018. And with that, I'd like to open up the floor to questions.
Wow, those net interest margins are right?
Yes, sir.
What's the industry average?
Industry average is right at 3.5.
So to get those kind of margins, they're making obviously slightly riskier loans. And how has their write-off been or non-performing loans historically?
7%.
Yep. How's that been historically?
Historically, right around that average, no higher than 0.3.
Okay, Tommy.
I was just wondering if you could walk us through your peer choices, because it seems that most of the banks you use exist in different parts of the country, or in the case of SVB, I know there's a pure play commercial bank.
Yeah, so that was kind of the theory behind it. Actually, I wanted a diverse array of regional segments, so to kind of get a comparison of how the different regional economies were playing out around. And then in terms of a couple of the different companies chosen there, for instance, Bank of Hawaii was the only one with similar return on equity numbers, and like you mentioned, was really similar in terms of balance sheet. So a lot of these are just pure play regional banks, just in general. So they have similar commercial loans for the one that you're specifically mentioning.
No.
Oh, sorry.
Oh, if you don't have a question. Nick, do you have a question?
Yeah, I do. Okay. National Business Lines. Yes. I know that they're National Business Lines is not loaning geographically within the state, I guess, but they're broader to the United States. Does that help them with the diversification of loans, or do they have to be more energy specific? Do they have to be more sector specific to get a larger percentage of the national business lines?
So they're actually still predominantly located in the regional markets with that. So that's about 60% is within the regional market mentioned, and then they'll spread the rest of the 40% kind of around where they see like best fit. In terms of energy, and that specific example, the business actually has zero energy loans, and the specific sectors that they have for that, a couple of the unique segments that they have is a timeshare loan business, warehouse lending, digital lending. Those are some of the more unique diversification segments that they go into. I also listed out some of the main segments of the national business lines within the top of the write-up. Those just include the mortgage warehouse, hotel franchise, tech and innovation, public nonprofit, corporate finance, and then other, which tend to be some more consumer-based loans. How big is timeshare? I don't have the exact numbers. That's within hotel franchise though, and I have stat on the timeshare loan business. They've had the business for over 35 years and they've never seen a loss within a timeshare.
How big of a risk do you think, like, I guess coronavirus and maybe some industry slowdown would be, especially within the region? I guess on the TV behind you, like a minute ago, it said it was the worst week for bank loans in a while, so how big of a risk is that to your company?
Definitely. So without a doubt, banks get hard whenever the market kind of takes a turn. Cyclical by nature, they tend to look like the market. And so when I kind of stick to the guns of how credit's been playing out over the last 22 quarters, we've seen increases in aggregate household debt. And we're seeing Nevada and Arizona being the two largest in terms of percent population growth. So people need spots to live in those areas, and that's not going to change. And seeing that shift into residential, I think that they're poised to kind of capitalize on a cycle that might not be beneficial heading up for everyone in the future.
So, you follow up?
No.
So,
Rocket Mortgage and Quicken Loans, just they're like pretty big in origination. How would that impact your second driver?
Second driver of mortgage origination. So just in terms of market share within those areas, I just tend to be confident in those spots. In Arizona, we actually have fourth in terms of market share, and Nevada is sixth. And so just given the healthy kind of space of the company within those areas, I'm confident in their outlook and their position to be able to take those, but those are definitely risks to the business if they're able to kind of undercut those. But as of right now, Western Alliance has been the most disruptive regional bank in itself, and those companies have been able to take on loans of the scale and size that Western Alliance is. So that would be my primary answer to the question.
Tier 1 capital ratio of 10%.
Yes.
How is that?
That's so the comps are around 11%. The requirement from regulations around 6%. So I kind of checked the box that 4% cushion is going to be acceptable for me.
Which Federal Reserve region?
San Francisco.
Yep. Did you look at any of that data to get?
I didn't love the things that they specifically within Arizona, so I actually looked at I looked at the New York Fed releases some little bit of interest reports I liked better, kind of from the region, and I also looked at University of Arizona reports. That's where I got the percent population numbers.
Questions? I think you did it. Want to wrap up?
Yeah, definitely. So I think Western Alliance could be a solid addition to the AIM Equity Fund because of its distinct business model, industry-leading fundamentals, regional growth opportunities, and high asset quality.
Right. Who's up? I'm going to go to my page. Joe, Aon. Can you sell some insurance? Sure. Okay.
Like Toronto, baby.
All right, Joe, all set?
All set. Hello, everyone. My name is Joe Bertrano. I cover the international financial sector, and today I will be pitching Aon. First, with my screening process, I wanted to find a company that has excellent growth drivers that also has an ability to convert top-line growth into bottom-line results. While the financial sector as a whole is struggling in times of slower economic growth, lowering yields, and tightening spreads, Aon as an insurance broker has excellent growth and an ability to translate that growth to earnings. Aon PLC, ticker AON, is the second largest insurance broker in the world. They specialize in commercial risk, retirement, healthcare, reinsurance, and data analytics solutions. Their largest portion of revenue comes from commercial risk, which is made up of property insurance and casualty insurance. Aon, being an insurance broker, does risk assessment on healthcare, tangible assets, and intangible assets. They also have an advisory business that is involved in capital markets and M&A advisory. The company was founded in 1982 and is headquartered in London. Now I'm going to explain what some of the activities an insurance broker does by using an investment bank as an analogy. An investment bank typically has buy and sell side advisory. Like buy side advisory, Aon is helping their clients purchase the right insurance plans that fit them best. So as I mentioned, they have buy-side advisory, and so when Aon helps a client make a purchase, they get a percentage of the insurance premiums that are going towards the insurance company. But to make a clear distinction, they're getting paid by the client, not the insurance company. An investment bank also can have debt capital markets and equity capital markets where they underwrite securities. Similarly, Aon can underwrite insurance-linked securities. These securities come in the form of catastrophe bonds. Investors can earn premiums given the fact that the trigger doesn't occur. Rather than there being an underlying asset, there's an underlying event that triggers a bond, and that would require the bond to be paid out. For example, a natural disaster. Investment banks also have a wall between their sales trading, equity research, and their M&A advisory. Similarly, Aon has a wall between their brokerage and relations with insurance companies. With that explanation, I'd like to move to my recommendation. From an operations standpoint, Aon is a leader in the insurance brokerage industry, focusing on small to mid-sized companies. Aon is the largest insurance-linked security underwriter. Aon Inpoint is their data analytics division, and it collected $100 billion in insurance premium data in fiscal year 19. The firm is embracing new technological advances in the industry. They recently developed Aon United and Aon Business Services. These platforms will allow the firm to capture more market share while not increasing costs. Aon United will connect the entirety of the company and their services so that the consultants and colleagues can offer clients more value and more services. Aon Business Services will cut down the wasted time spent on repetitive work, and in fiscal year 19, the organization cut out 600,000 hours of repetitive tasks among their subsidiaries. Their commercial retail brokerage, which is their largest portion of revenues, has a retention rate of over 90%. From a financial standpoint, Aon has just finished their restructuring plan that started in fiscal year 17. This restructuring plan expected to save $580 million in 2020 and is part of the reason why margins will continue to expand into the future. There's new business opportunities in reinsurance and commercial risk, but there's also higher growth in healthcare and the retirement segment. The retirement division will have the ability to reach 5% organic growth due to new opportunities from the Secure Act. Medical spending is predicted to grow 5 times the rate of inflation, which will help boost their healthcare division. Due to Aon's high growth potential in cyber insurance, insurance-linked securities, and digital insurance premiums, it is recommended that Aon PLC be added to the AIM International portfolio with a price target of $272, representing a 21% upside. Now onto my drivers. First, cybersecurity insurance market. The cybersecurity insurance market is expected to grow at a 41% CAGR from 2019 to 2024, according to MarketWatch. Aon is positioned well to help companies with cybersecurity consulting with their acquisition of Cytelligence and their current cybersecurity division. They are also well positioned to capture the growing cybersecurity premiums market. It is estimated that Aon's EPS will grow by 30 cents in fiscal year 24 from cyber insurance sales, and this is not including their cybersecurity and consulting, which will grow Aon's EPS by 10 cents in fiscal year 24. Now on to the gap in insured losses. According to Aon's assessment of the reinsurance market in 2019, there was a $230 billion in economic losses due to natural disasters, while there was only $70 billion in insured losses. Management wants to close that gap. The amount of insurance-linked securities issued is growing, and Aon's fiscal year 24 EPS will grow by approximately 12 cents due to issuing of catastrophe bonds and 17 cents related to consulting from natural disasters. Now on to my last driver, online insurance quotes. Aon recently added CoverWallet to their new ventures portfolio and is a fintech that specializes in commercial insurance. They piloted the platform with new business leads and had double the success rate through increased conversion, cross-selling, and sale of ancillary services. CEO Greg Case also noted that there was an increase in the penetration with current clients of 20%. And there's also currently a $200 billion premium market for small businesses, where only 5% of it is being served digitally. It's estimated that EPS will grow by 35 cents in fiscal year 24 due to this driver. For the sake of time, I'm going to skip my evaluation and move on to my risks. First, the coronavirus. Aon has 2.3% of revenue coming from mainland China. Insurance solutions may be more difficult to offer during a time where risk analysis is more challenging. It also has the potential to raise costs for Chinese businesses to the point where they can't afford insurance premiums. Next, foreign currency risk. Because Aon has branches and sales across the globe, they are subject to foreign currency risk. They have currency hedging strategies. However, in 2019, their income declined 3% due to foreign currency charges. This had a net effect on earnings of 23 cents. The continuing strengthening of the U.S. dollar looks to be a trend and is unfavorable to the company. Lastly, private healthcare reliance. Aon's healthcare business relies on private health insurance increasing in the U.S. If there's a decline in private health insurance due to a public healthcare system, this would affect Aon. Next, I'd like to end on management. Greg Case has been the Chief Executive Officer of Aon PLC since 2004. Mr. Case has made it on the top 100 best performing CEOs 4 times on Harvard Business Review's list. Prior to Aon, he served on the Governing Shares Council at McKinsey & Company. Krista Davies joined Aon as an Executive Vice President and has been CFO of Aon PLC since November 2007. And with that, I'd like to open the floor to questions.
All right, I looked at Cover Wallet. Did you go out there and look at that?
Yeah, I did. It's really exciting opportunity, and it was surprised me that so little of the brokerage market is being served digitally.
Yeah. So how quickly are they able to offer a quote? I went to that site. I didn't go in and look for a quote, but if I were a restaurant or some other small business, how quickly can they come back with a quote?
I think it's within minutes. I'd have to look more into that. I think it depends on the size of your company and what you're looking for, though.
Which then begs the question, how good must their analytics be in order to do a quote on a business that's little information is being entered in the app and they're still able to come back with an instantaneous quote? Do you feel comfortable with that?
Absolutely, and I think that I'm very confident in this, and I think that the fact that they piloted the Cover Wallet with their other business leads and had more success with it, I think is a sign that this is something that's going to continue to grow within the company.
They acquired it. Do you know when and how much?
It was on February 4th, but it was a private deal, so they don't have disclosing on it.
Go to TechCrunch, you'll find out what they paid for it. Why aren't we doing that, okay? I mean, starting up fintechs and selling it to big insurance companies.
Good deal.
We can do that, right?
So going to your first boxes, your WAC is 5.45% when you're really highly levered. Could you give a little color as to why that's so low?
Well, actually, the leverage helps lower the WAC. No, it's okay. If you'd like, I can kind of go through my WAC calculation because that's kind of important. So they have about 70% debt to equity ratio, or in weighted in terms of the WAC, and not, as you'll see, not my debt to equity ratio. I mean, in terms of the WAC calculation, my I added an equity risk premium for coronavirus and for the currency, and so I think that my WAC calculation is actually very conservative.
Thank you.
Your dividend yield is a little bit lower than your peers. Do you have any comments on that?
Sure. So actually, I think this is good for the company. The reason being because they have much more growth than their competitors. For instance, their largest competitor, Marsh & McLennan, has about 2% to 3% organic growth, while Aon as an entire company has 6% organic growth. So by having a lower dividend yield, they're reinvesting that growth to drive more sales. So I think that it's not necessarily a negative sign.
So, I applaud your use of trying to break down into incrementals what each one of your drivers, 10 cents for the first driver, 29 cents for the second, and then 35 cents for the third.
Yeah.
What do you think that's, on a present value basis, what do you think that's worth to a shareholder?
In terms of, I probably have to get back to you on that in terms of present value analysis.
Better yet, what kind of valuation outside of present value do you think that's worth? Not present value, just.
Okay. Well, I mean, looking at my PE multiple of average of 27 times, I think that would be worth. Sorry.
It turns out to be $16.
$16, yeah.
Just in terms of magnitude, just as a hint, as I look at it, each one of the drivers should be at least 10% impact to the price objective.
Okay.
So when you add it all up, you come up with about I think 65 cents or something like that.
Yeah.
Out of 2014, it comes out of these factors.
Yeah.
When you have a stock that's over $200 and the earnings in 2020 of $12, so it's less than 5% of impact.
Yeah.
So I'm just
Yeah.
making an observation that if you, kind of a teaching moment, if you have a driver, try to have it such that it's really impactful, at least 10% of the impact of this time.
I would say that maybe to touch on that, my drivers are 80% of their EPS growth in fiscal year 24. And I think that since they're such a large company, I think that having a driver that would be too large, that might be unreasonable to assume. But thank you, I will keep
That's
that.
fair.
All right, so
That's fair.
Thank you.
So your second driver, where you talk about the CAT bond, the catastrophic bond market.
Yeah.
Always one of my favorites.
Yeah, it's very
Who doesn't
interesting.
like bonds and natural disasters?
Yeah.
How good is that? Okay. So I love CAT bonds. They're the underwriter.
Yes,
Yeah.
number one.
So that market, do you know how large it is?
It's so it's about I know that in 2019 there was $5 billion in issuings of cat bonds. So and I think it's the entire market's around $90 billion.
Yep.
Might be a bit larger.
So they're underwriter only. They
Correct.
will just assist other insurance companies who want to go out and sell it to the investment market.
Yes.
Do they hold any of that on their balance sheet?
None
Pure
whatsoever.
underwriter.
They don't take any risk on their balance sheet whatsoever.
Okay. They don't maintain. Okay, well, let us talk about cybersecurity.
Sure.
Who are the insurance companies they're representing, do you know, for the issuance of the cybersecurity?
Well, so there's sort of many different players. I don't have the list in front of me, but Aon is merely doing the sort of risk analysis in this transaction.
Yeah. What's the big rusty skyscraper in Chicago? Is it CNA? Because they're one of the big writers of cyber security. It's kind of broad. It's a big building. Come on, you Chicago guys. What is? No, that's Sears Tower. Okay, so how large is that market? It's growing.
Yeah, it's expected to be $17 billion in fiscal year 24. So even though it's maybe smaller than the premiums market, it's much faster growing. And since Aon is one of the main competitors in the space, they definitely can gather more market share.
Okay, summarize.
Yeah, so Aon is a large company but has excellent growth opportunities, and not only that, can convert those growth opportunities into bottom line earnings. And with that, I'd like to recommend Aon PLC. Thank you.
All right. What am I missing here? This is going well. John. Okay.
Good afternoon, everyone. My name is Ivan Jimenez. I'm a junior in the AIM program, and I cover international communication services. Today I will be pitching Millicom International, ticker TIGO. Millicom International was founded in 1990 with a vision of creating digital infrastructure that connects people in emerging markets. The company offers mobile and cable services under the Tigo brand name, hence the ticker, to 48.3 million individuals and 4.1 million homes and businesses in South and Central America. Millicom's main operating segments are business-to-consumer mobile, which consists of traditional data, text, and voice services, as well as mobile financial services, business-to-consumer home, which I will also refer to as fixed line throughout this presentation, consisting of traditional pay television, broadband, and telephone services, and business-to-business, mobile, fixed, and other value-added services. I will now move into my drivers. Acquisitions in Central America. In 2019, Tigo closed on the acquisition of competitor Telefónica's businesses in Nicaragua, Costa Rica, and Panama for $1.65 billion. This added 8.7 million mobile customers in three countries that previously only had fixed line services. Consumer spending in communication services is projected to grow at a 10-year CAGR of 2.9, 3.8, and 5.9% in Nicaragua, Costa Rica, and Panama, respectively. Tigo now ranks first and second in terms of subscriptions, in all their operating segments in Central America, where it projects to derive 55% of its revenue in 2020. At this point, I'd like to note that Millicom has operated in Africa since 1993, but began to divest from the region in 2017. These acquisitions in Central America are a continuance of the strategic allocation of capital to higher margin areas. Management predicts revenue from Africa to be less than 5% in 2020 and does not cite it as a strategic focus that contributes to any of their capital decisions. Operational shifts. Management has identified HFC or hybrid fiber coaxial networks as a major driver not only for revenue growth, but increasing margins. These networks combine high-speed fiber optic nodes to traditional coaxial cables that we often refer to as just cable. Fiber optic networks connect directly to users, while cable networks are shared by many users and are therefore typically cheaper and slower. So therefore, HFC combines those two for a balanced user experience. HFC relationships generated 7.2% of year-over-year organic growth in quarter 3 of 2019. Millicom is deploying broadband services over this HFC network, resulting in higher cross sales, a very important aspect of telecom operations, and lower operating expenses. The company is also moving customers towards unlimited mobile plans that reduce costs further and yield longer customer relationships. The fight in the dog. Millicom is often bullied by large competitors who leverage their pricing power in shared markets. As of quarter 3 2019, the company's mobile ARPU, or average revenue per unit, decreased 11.5% year over year, largely due to price wars in Bolivia and Paraguay. Still, Tigo has managed to maintain and often grow mobile subscriptions in this harsh environment, a testament to their strong customer relationships. Now on to my recommendation. Millicom has successfully changed the way individuals live their lives at home, work, and between each other. Their products include Tigo One TV, the company's signature pay television network, Tigo Business, reliable fiber optic networks, cloud services, and other solutions, and Tigo Money, a mobile financial service platform that provides greater access to funds for largely unbanked areas. Millicom determined it was time to access American capital markets and listed in the NASDAQ in January 2019. Since then, the stock has dropped 30%, roughly 30% as a result of significant economic and political turbulence amplified by the competition that I previously described. Despite bearish market sentiment, Tigo continues to increase its Latin American footprint, increasing 4G coverage from 45% to 68% from quarter 3 2016 to quarter 3 2019. More importantly, their penetration rates, which measure the percent of a company's target market that they have as subscribers, is 30.3% in cable networks and less than 35% in mobile networks, indicating great growth opportunities. Now on to my evaluation. In order to reach an intrinsic value for Tigo, a 5-year DCF model was constructed, using a terminal growth rate of 1.5% and a WACC of 5.66%. An intrinsic value of 68.46 was reached. Additionally, a price-to-sales peer valuation was conducted using a price-to-sales multiple of 1.14, resulting in an intrinsic value of $48.87, and an EV to EBITDA multiple valuation was conducted using a multiple of 7.54 times, resulting in an intrinsic value of $63.93. By weighing the models 50, 25, 25, a price target of $62.43 was reached, representing a potential upside of 31.5%, and Tigo pays a dividend yielding 5.5%. I've touched briefly on my risks, so in the interest of time, I will instead share 2 quick notes about Millicom's quarter 4 earnings report Tuesday that I believe support my recommendation. Sales increased 6.4%, 1.6% organically for the year, mostly due to acquisitions in Central America. It also increased depreciation and amortization by nearly 28%, which depressed operating income by 12%. Of course, this will stabilize in the future. Next, the company organically added 312,000 postpaid subscribers versus 270 in 2018, which is now 61% of service revenue. This was largely due to 34% organic growth in 4G subscriptions. These are very strong numbers that I believe will yield more growth moving forward. And with that, I will now open the floor to questions.
All right, interesting company. This is the first time we've seen this. Really global footprint too. And still in Luxembourg, but a lot of activity all over the globe. Your margins, your operating margins, kind of bounce around a little bit.
They do.
Okay, you want to explain why you've got some fluctuation in that?
Yes. So this is largely due to depreciation and amortization, which I modeled as a percent of price.
Say no more. That's good.
Oh,
That's excellent. Good job.
So, according to your PE valuation, your company is overvalued. Do you want to sort of defend your valuation method and talk about that a bit?
In other words, he's saying, did you cherry pick your metrics?
Yes. So in regard to the price to sales multiple, I would actually agree that it does suggest that that this company is overvalued, and that's in that particular aspect. I think this was I chose this as a valuation in order to be a little bit more conservative with the overall intrinsic value.
It looks like you're getting most of your value from your rollout from AT&T and Verizon, which are just significantly larger companies. Can you maybe defend that or have them comps a little bit?
Yes. So first, I'll note that I did weigh those less, and yes, it still does result in a significant part of the upside. My theory behind that is, or my reasoning rather behind that, is that Millicom International is operating in markets that are currently beginning to stabilize. I'm not suggesting that they will reach the multiples of a company as large as AT&T or Verizon, but I do think that it's worth noting that it will approach those levels moving forward as all this uncertainty surrounding the economics and the politics begins to clear up.
The only thing that really worries me about your company is your 28% revenue exposure to, I believe you called your fixed line of your fixed B2C home.
Yes.
Considering that pay, television, broadband, internet, and telephone services are all particularly dying technologies at the consumer level, can you touch on why you're confident in that line going forward?
Yes, I'm actually really glad that you mentioned that because it's important to note that this is a company that's operating in emerging markets. Therefore, whereas the whole world is moving towards 5G, for example, this company is moving to expand their 4G networks. That being said, the cable networks, broadband and home television that you mentioned are still a significant portion of Latin American culture. So I still feel strongly in its ability to drive sales.
Perfect answer. Thank you. Riley. So in your peer boxes, your ROE and your ROA are pretty low, and you also issue a dividend. Do you think that the dividend will be beneficial for them over the long term versus taking that cash and reinvesting it into the company to grow those margins?
Yes.
Can you just give a little bit more color on that?
Yeah, absolutely. So first I'll address why the ROE, ROA, why the return metrics are so low. In 2014, the company revalued a portion of their business in Guatemala to a fair value of $2.3 billion, recognizing an untaxed gain that resulted in deferred tax liability. This tax liability, in combination to the tax that they pay in the operating countries, as well as the tax from withholdings in Luxembourg, has contributed to effective tax rates of, effective tax rates of sometimes 80%, 100%, 120% in the past 3 years. This is the largest contributing reason for low net income, and that's why the returns are so low.
And following up on that, do you see that trend changing anytime in the future? Because all those numbers that you just gave only increased, and so do you see that decreasing anytime within our holding limits?
Yes. So, most recently in 2019, one second, I just want Yes. So in 2019, that number was down to 54% because it's mostly been paid off, and it's going to continue to be paid off through at least 2024, but at significantly lower rates, which is why you see earnings per share going up moving forward.
So your midterm revenue and earnings rate is not like there's a huge gap between them. And can you guys give us a color about the difference between the top line and the bottom line?
Yeah. So I just want to be clear. Your first question was in regard to the revenue growth rate.
Your midterm revenue growth and your earnings per share growth is a lot more like there's a huge gap in between. Like you have 13.69 and 2.75. And I was just wondering, what's your reasoning between?
Yeah. So first, I want to point out that in 2019 and 2020, because of the depreciation that I mentioned earlier, affected by PP&E, that throws off the numbers a little bit between 2019 and 2021. It begins to stabilize through, in my projections, from 2021 to 2024, which averages at a growth rate of about 3%. So that's the discrepancy right there with the revenue growth rates. And as it translates to earnings per share, as it translates to earnings per share, I've projected that cost margins to decrease and depreciation and the revenue growth top line. Excuse me, I'm sorry. Just make sure I got that.
You can get back to it.
Yes. Yeah. I'm sorry. I'll get back to you on that.
We'll do two quick ones. We have Christian.
So I have a question about, so your debt equity ratio is higher than your comps, and in the most recent earnings call, they talked about wanting to deleverage. Do you have like an understanding of what their roadmap might look like in order to achieve that?
Yeah, so the debt to equity ratio that you mentioned is largely because the acquisitions in Central America were funded through debt, and in terms of deleveraging, I want to look into that a little bit more, but the capital investments that they're making moving forward are largely out of their free cash flow, which would in turn slowly start to decrease that debt to equity ratio. But I don't have more details on that right now.
We got two more, Haley, and then Vince.
Did you model out when your ROIC will surpass your WACC?
That's a good question. I don't have it modeled out, no. I would estimate that would end up turning up between 2022 and 2024, but that's an estimate right now.
Good.
Thank you.
In your third driver, you note that the company is vulnerable to competition, which is depressed its average revenue per user for mobile distribution. What's the company's competitive advantage, if any, and what's their plan to reverse this trend of decreasing average revenue?
Yeah. So the company has taken a strong strategic focus in where they allocate their capital, which has made it the number one or number two, as I mentioned, telecom company in its operating markets. The majority of the competitors that have historically diminished their average revenue per unit operate in more established markets like Brazil, for example, and Chile and Peru. So they have a large market share in those regions, and as they transition to postpaid subscriptions, that will slowly begin to increase their margins. And yeah.
We're gonna do one more. Sean, you took your coat off. You get to ask a question.
So in May of 2019, they announced a repurchase plan of 350,000 shares. That's going to be effective between today and May of 2020. I was wondering if you priced that into your model or.
It wasn't priced into my model because I don't feel that that's necessarily the most organic way of yielding shareholder equity. increase in stock price. But I do think that they're doing that at a time where the company is undervalued, and I think that that's going to contribute to their deleveraging moving forward.
All right. You get to summarize. 10 seconds.
Yes.
15 seconds, whatever you want.
Sure. So I think Milcom International is at a very exciting point in its lifetime. It's been beaten up for several years, and at this point, everything has been lined up to where they can translate into revenue growth moving forward. And I think that this is going to be a strong growth story.
Okay, and best tie of the day so far, too.
Thank you.
All right, last presentation of the day, a technology company, Andrew Hoy. Yeah. And that's a good time, too.
Thank you. Hello, everyone. Thanks for coming. My name's Andrew Hoy, and today I'm going to be pitching a company called F5 Networks. I'd like to begin by making a correction to my boxes. F5's ROIC is not 49, but rather 28.08. 49 is actually their cash flow return on invested capital. So F5 Networks provides multi-cloud application services for the development, deployment, and management of network applications, servers, and storage systems. Their offerings include app security, traffic management, cloud, automation and orchestration, and service providers. They segment their revenues by products and services, 40% and 60% of total revenue, respectively. It conducts most of its business in the United States, 50.7% of revenue, but also serves customers abroad, including mainland China, Japan, Germany, and India. The company is headquartered in Seattle, Washington, and was founded in 1996. I'm going to move on to my recommendation. Since its IPO in 1999, F5 has been a leader in the network communications solution space. While top-line revenue may appear to be growing slowly, this is only the result of the company increasingly pivoting away from relying on its product segment, which serves a saturated market. Their product offerings address traffic management, cloud, automation and orchestration, and service providers, and services include consulting for app deployment, maintenance and optimization, and security incident response, which helps protect against data breaches. For example, if I were an app developer seeking to simplify the process of bringing my product to market, I would go to the Amazon Web Services Marketplace and pay F5 an annual fee to assist in the app's development, deployment, and management. The services segment has been growing, up 50% year over year in Q1, and is expected to re-accelerate to the high single digits in 2020. This is expected to be driven by higher contract renewals from their recent acquisition of NGINX, benefits of a global software transition, and improved demand for consulting services. Their revenues are primarily generated from the sales of a network operating system created for designing, deploying, and managing network applications through enterprise licensing agreements and on a subscription basis. Their offering is highly differentiated because prior to its release, companies were getting inconsistent application services from multiple vendors across various teams. 2018 marked management's commitment to embracing subscriptions as a main source of revenue, securing software as a service contracts with Amazon Web Services, Microsoft Azure, Google Cloud Platform, and Alibaba Cloud. F5 has pursued growth both through an organic and inorganic strategy, and has had two recent acquisitions. In 2019, the company acquired NGINX software, an open source API architecture that is both a web server and a proxy rolled into one. The web server portion serves web content to users, and the proxy portion provides for the server's load balancing, backend routing, and caching. Moreover, the company purchased Shape Security in 2018, adding cybersecurity to their product portfolio. While investors have favored the diversification aspects of the recent acquisitions, share prices have reacted negatively to the near-term earnings dilution. This has resulted in the company trading well below its 52-week high and at an attractive valuation. F5 Networks is recommended to be added to the AIM Small Cap Equity Fund with a price target of $142.55, representing a 12.43% upside. Moving on to my drivers. Merger synergies. According to 2020 market study, 62% of organizations say that applications are essential to their business, and 69% of businesses are reported to be using 10 or more application services at once. As a result, the combination of F5 with NGINX and Shape creates a cutting-edge, all-in-one application services platform that integrates the development, deployment, management, and security of the applications. Leveraging its shift to software as a service, the mergers will continue to increase top-line revenue while maintaining their massive gross margins. The Shape acquisition alone is expected to add greater than $50 million to the top line and only $25 million in OpEx in fiscal year 2020. A need for cybersecurity. Nearly every organization uses the public cloud to participate in industry ecosystems, leverage cloud-native architectures, and deliver applications to support their businesses. Despite their dependence on virtual infrastructure, F5 has found that 87% of organizations are less confident in their ability to defend against an attack in the cloud versus an on-premises data site. In Q1 20, the company acquired Shape Security for $1 billion, adding 9 Fortune 50 companies, 8 of the top 12 U.S. banks, and 5 of the top 10 credit card issuers as F5's clients. In 2018, Deloitte ranked Shape the #1 fastest growing company by revenues in Silicon Valley, and with Shape's annual recurring revenue of more than $70 million, the deal more than doubles F5's total available market and application security to $8 billion. My last driver is a push towards automation. The network automation has become a trend as organizations increasingly necessitate gains in speed and consistency in their rush to deliver applications to market faster. Even though automation is on the rise, management contends that we're still a long way from the model necessary for businesses to capitalize on the digital transformation. The company's automation toolchain offers composable components that allows you to easily integrate F5's platform using modern automation patterns. According to Global Market Insights, the market for U.S. network automation services is expected to grow at a CAGR of 22% from 2018 to 2024 and was estimated at $1.7 billion in 2017. For the sake of time, I'd like to skip my valuation and move on to my risks. My first risk is a fragmented market. The application delivery market is highly fragmented, forcing the company to compete with giants like Cisco and Palo Alto Networks. Though F5 provides a highly differentiated product offerings, increased competition in the space has already put pressure on revenue from products. A faster than expected transition to hybrid cloud. Part of F5 Solutions portfolio derives demand from organizations' need to integrate their legacy networking hardware with the emerging cloud-based environment. A faster than expected transition to the hybrid cloud could present challenges for the company. Reliance on distributors. The company relies on 3 main distributors for their product sales. Ingram Micro, Tech Data, and Westcon account for 18.2, 10.2, and 10% of revenue respectively. Any of these 3 companies beginning to sell a competitor's product could impact their top line. Management. F5 is spearheaded by Francois Locodono, who has served as president and CEO since 2017. Frank Peltzer, the CFO, joined the company in 2018 from SAP, where he was COO. He previously has held senior leadership positions at Deutsche Bank. Senior Vice President of Shape Security is Derek Smith, a former senior advisor for cyber policy at the DoD and the former VP of cybersecurity at Raytheon. Finally, the Senior Vice President of NGINX is Gus Robertson. With that, I'd like to open it up to questions.
All right. Lots of interesting things here. I don't know why we're not starting these companies and selling them. This cyber security company Shape that they acquired.
Yeah.
What do you know? Do you know? I know what they paid. How did they pay for it?
Yeah.
And does that complement other cyber investments that they have?
Yeah. So how did they pay for it? They used a majority of cash from their balance sheet, but they also took out $400 million revolving credit agreement. And so that actually, prior to the acquisition, they had no debt. Their debt to equity was 0. So I actually factored that into the not only the debt to equity ratio, but also their ROE.
Okay. You like that space. That's got major growth for you.
Yeah.
What, you have services, you have products. Do you have any idea how much cybersecurity is a part of their business?
Yeah, so right now, it's relatively small, but they're really trying to pivot away from, as I mentioned in my write-up, they're really trying to pivot away from their product segment and into this market. So Shape represented in Q1 a $12 million contribution. So if you with no growth, if you extrapolate that over the 4 quarters, it's 48 million. And then also Shape's revenues increased over 50% year over year in 2019, so it's a really fast growing company.
Okay.
So your first box, your market cap is 8.1 billion. Today it's like 6.5. Is that consistent with our IPS?
Yeah, so actually I looked into that. That was one of my main concerns with this company. But the largest company in the Russell 2000 is like 9 billion. And so I figure if we're under the largest company in the Russell, then we can pitch it.
If it keeps going down, it's going to be in the Russell 2000 by next Friday.
Exactly.
All right. Oh, we're here. Tommy.
Yeah, I just noticed you have ESG in your box. Do you know what your ESG score is?
Yeah, I do. Thank you for asking that. Actually, their ESG, they're triple B, and that's mainly from human capital. So.
Yeah, because they're probably all guy engineers that work for the company, which is
exactly.
We got to change that. We need girls who code. Who's next? Yes.
So your company acquired Shape Security for $1 billion at price to sales ratio of 14.3 times.
Mm-hmm.
And before NGX, the company has not made an acquisition since 2017. What makes you confident that the firm will be able to effectively integrate the company, and do you think it was a good deal?
Yeah, so I'm going to address your last point first. Do I think it's a good deal? I think they might have overpaid a little bit, but I think that the long-term revenue gains far outweigh the near-term dilution, and you can see that just from looking at my price chart that the dilution is what the market's been pricing in. And then to address the other part of your question, I'm sorry, could you repeat the last part?
Do you think that the company will be able to effectively integrate the acquisition?
Yeah, so to answer that, I'm going to go back to the NGINX acquisition. So the companies have only been married for 3 quarters, and they've already successfully launched a new product. So I think that they're focused on spending down or paying down the debt from the acquisition, and also spending big to integrate the two companies.
What about shares or Shape Security?
What about it? Do I think they're going to be able to integrate it? Yeah, so I think that if they take a similar approach to the way they did NGINX, it'll be successful for them.
Okay.
So looking at your peer fundamentals,
Yeah.
Arista has a higher ROE, ROA, and ROIC, all with a lower debt to equity.
Yeah.
How would you defend F5 over Arista?
Yeah, so I think my main argument against Arista is basically that basically just the fact that they're not exposed to the cybersecurity market and they're not growing as aggressively. I think F5 is well positioned with I think their product is really highly differentiated in the fact that they provide an all-in-one services platform where Arista does not.
Shay, you're the only senior here who didn't go to the same practice day, so you get to ask a question.
So did you model out what would happen, like without the revenue growth, without this acquisition at all?
Yeah, I did.
So what would revenues grow at without the acquisition?
So without without Shape?
Yeah, without Shape.
Yeah, so I have revenues going at about 11% right now, just the services segment, going at 11%. So without that, I'm thinking that it would be about minus 50 million, just because that was the contribution in Q1.
So on your valuation section, could you walk me through why you use a PE multiple when you're trading at 19.8 and you used a multiple 18.5 for 1.5?
Yeah, so great question. So hold on, where is it? So yeah, actually that box is last 12 months PEs, and in my valuation section I use next 12 months PEs. So
yeah, too bad we had the lecture today before you wrote the paper, right? But
yeah,
you got it now. Anyone else? Interesting company. When you described this to some visitors in the room about 2 hours ago, you did a nice job. And before you do your summary here, talk about apps and how this company fits into and how they derive their revenues.
Yeah, so basically, to put it quite simply, they're uniquely positioned in the data flow where they can, where they assist in the development of the app. So not only the development but also the traffic management portion of it. So basically, in my write-up, I put in an example. So like if I were an app developer seeking to simplify the process of bringing my product to market, I'd go to the AWS marketplace and pay them an annual fee to assist in developing and also for consulting or whatever needs that they would have. And also they make money on software, so they're shifting to a software as a service model, so they have subscription revenues, and a lot of it is.
So if I want to build an app for AIM, I could use them. Correct. They would help me get access to cloud AWS. Yep. They're going to get some sort of fee because they're going to be the one that's going to be controlling the flow of information between the thousands of people that want to use the AIM app, okay, correct, and the cloud. Okay. Yeah. The last question.
Do you have a sell rec in mind?
First of all, what did you buy, and then roll right into a sell.
Okay, yeah, so, I'm sorry, what do you mean, what is my buy?
Your pitch, your final.
Okay, yeah, my summary. Okay, so in short, I think that F5's efficient business model and recent acquisitions position them well to take advantage of secular trends in the IT space. The company's product mix is currently 72% hardware and 28% software. Despite this software having higher margins, now accounts for more than 60% of revenues and is growing. I contend that F5 is currently undervalued as the market is placing too much emphasis on the near-term dilution and disregarding the synergies of the acquisitions. They continue to play a significant role in improving the performance, availability, and security of server and web applications as reflected by their partnerships with some of the largest software vendors, including Microsoft, VMware, Oracle, SAP, and IBM. And
yourself.
Yeah, I haven't looked into a sell yet just because my sector has one holding, Iridium, so I'm going to have to take a closer look at that.
Well, we can always overweight, okay?
Yeah.
So we'll do that. Well, Andrew, thank you very much.
Thank you.
I don't know what Dr. Mall was grousing about. These were nice presentations today. You all did a fine job. For all of you who are here, including sophomores and friends, thanks for coming. It's always good to have you view these presentations, and your questions are appreciated. Have a good weekend. We'll be back at it early next Friday, probably about 1 o'clock. We'll lock in on that time definitely, but enjoy your weekend, all right? Shady, did I keep you here?